So you're selling your property and you've got a massive capital gains tax bill. What do you do next? Hi everyone, Amir Aishak here from Property Tax Specialist. I'm here to help you navigate the complexities of Australia's property tax regulations. There is no doubt that it's quite overwhelming for investors to be hit with a significant capital gains tax bill after selling their property. No one wants to pay thousands of dollars of their hard-earned profits. So what can you do? Well, luckily, there are a few ways that you can legally minimize your capital gains tax obligations and maximize the returns on your investments. And that's what I'm going to share with you today. But before I do that, you should know that the information is intended to be a guide only, providing an overview of general information available to property buyers and investors. This guide is not intended to be an exhaustive source of information and should not be seen to constitute legal, tax, or investment advice. You should, where necessary, seek your own advice for any legal, tax, or investment issues raised in your affairs. Okay, so the simplest way to minimize your capital gains tax is by holding onto your property for more than 12 months before selling. If you do that, you may be eligible to claim a 50% discount. For example, if you sell a property that you've owned for more than 12 months and make a capital gains of $220,000, you'll only be charged CGT on half of that, which is $110,000. Unfortunately though, if you use the company structure to buy your property, you won't be entitled to the same discount. Another simple way to reduce your capital gains tax bill is by offsetting your capital gains with capital losses. Capital losses from the current or prior years can be used to reduce your capital gains and therefore the amount of capital gains tax you need to pay. You could also increase your property's cost base. Essentially, when you calculate capital gains tax, you're working out the difference between the selling price and your cost base. The cost base includes the purchase price, stamp duty, legal fees, agents' commissions, and renovation costs. I've done a detailed video on calculating capital gains tax, which you can check out. But basically, if you can increase your cost base, you can reduce the capital proceeds and ultimately reduce how much capital gains you'll have to pay. You will need to keep good records of the amounts incurred. So make sure to include all the associated costs of acquiring and disposing of the property. Another helpful strategy is revaluing your property. What often happens is property buyers live in their first property and then end up turning it into an investment property once they can afford to buy another property. It's a good strategy if you're looking to grow your property portfolio. But if you decide to turn your main residence into an investment property, get it valued before you rent it out. This is important because you'll be liable for CGT on the capital gains you make from that point forward and not going from when you first bought the property. This is because you can only claim one main residence at a time. The last tip I can give you when it comes to minimizing your capital gains tax is to talk to a professional. Property tax can be complex. For example, are you paying too much tax on your property investments or missing out on tax deductions? Even with research, it's difficult to know what is relevant to your situation. And it's important to understand that tax minimization is a legal and sensitive strategy. Tax avoidance, on the other hand, is not and carries heavy penalties. Here at Property Tax Specialists, we're used to dealing with complex investment portfolios, so we know the best way to structure them and to legally reduce the amount of tax you pay. Understanding your tax position is key to making informed decisions about your property portfolio. We prioritize ongoing tax planning and use projections to determine your tax position at any given time. By taking a proactive approach, you'll never be surprised by a massive capital gains tax bill at the end of the financial year. I hope you found this video helpful. If you have any questions or would like to talk to one of our tax experts, get in touch today. Otherwise, make sure to like and subscribe for more property investment tax tips. See you next time.